Good afternoon. We are Team Poly, and today we'll be presenting our investment thesis on Raia Drogasil.
But first, what is Raya?
Hydrogazil is the largest drug retailer in Brazil, both in store number and in revenue terms. It has a strong footprint throughout the country, but its core remains São Paulo, which accounts for half its revenue.
Of Raya's four product groups, generics have the best margins, but most of the revenue comes from branded. The company is known for its outstanding execution, and since Raya and Drogasil merged in 2011, net income increased impressive 260%, and stock prices rallied over the 100% in the last year.
So, is it time to invest in Raia?
No. Hydrogazil is a great company, but that is now unlikely to surprise the market. Therefore, we issue a hold recommendation with 109 reais target price for the end of 2010, resulting in an upside of 8.8%. The company seems to be priced to perfection, leaving investors with little margin of safety.
Our investment thesis is based on four main pillars: a promising industry, a prime competitive positioning, ability to expand and face competition, and finally, a demanding valuation, with both high growth and profitability already priced in.
Tell me, why is the sector so promising?
The industry is extremely resilient. Despite recent years' recession, it grew with a 12.8% CAGR, creating a significant spread to GDP. On the other hand, the sector may also benefit from positive macro perspectives, since most of spending is out of pocket.
Beyond a positive macro scenario, Brazilian demographics drives growth on the road ahead. Age pyramid is set to invert, and elders will represent a quarter of the population by 2060. They consume medicine twice as often and spend four times as much as younger people.
And what is the takeaway? Aging drives industry growth, as we can see in the strong correlation between market size and percentage of elders. An R-squared of 0.99 enables us to extrapolate this model and estimate market size for the next 5 years, obtaining a 9% CAGR.
We also see the market fragmentation as an opportunity. We estimated an HHI of 229 and identified that top players hold 28% of the market, a level still much lower than those of countries like Mexico and Chile.
So, the industry will thrive and there is room for consolidation, but how is Raia positioned? Let's first take a step back to understand how a consumer chooses a pharmacy. We see that the primary decision factor is price, followed then by convenience.
In the pharmacy business, low product differentiation and weak customer loyalties drives companies to compete on pricing. In our field research, when analyzing a 20-item basket, we saw no company holding a clear edge.
Therefore, convenience is where the company stands out. We conducted a geospatial analysis to evaluate Raia's store position in São Paulo, its main city. We used QGIS software and census information. We plotted all stores from Droga Raia and Drogasil, as well as the PSP and Pague Menos, its main competitors. We concluded that Raia concentrates its stores in the most attractive neighborhoods, with the highest percentage of elders and average income. And as for the rest of Brazil, we see the same pattern repeated. Raia positions its stores in the richest locations.
And what does it mean for the company?
It has the highest sales per square meter and the second highest average ticket in the whole industry. But this prime positioning comes at a cost. These attractive neighborhoods are also highly competitive, and we see São Paulo as a consolidated market, therefore not an expansion vector for Raia, which is now deconcentrating stores openings and moving into new regions.
And what about e-commerce?
Raia Drogasil is also well positioned in the segment, especially after it acquired on-offer from CVS Pharmacy. It has the highest share of online drug retail traffic and a well-developed omnichannel that benefits from store capillarity. However, e-commerce is still little representative, accounting for only 2.5% of revenue, with high regulatory barriers in the domestic market restraining its expansion.
It seems that Raia has a strong positioning, but what else makes it a top pick to serve the sector's tailwind?
First of all, Raia has unmatched organic expansion capabilities. It has opened nearly 900 stores in the last 4 years, all sustained by a consistent and solid cash flow generation. The investment to open a single new store is not very high, but maturation curves delay break-even points, making it hard to cover for capex in the first years.
Other players even try to keep up with Raya's expansion pace, but as they faced margins and cash flow deterioration, they had to raise their leverage to expand. Eventually, their expansion momentum was lost, while Raia was able to keep its rhythm.
And what explains this difference?
Prime store locations, along with outstanding store-level efficiency, explains how Raia maintained good results while expanding. In a visit to a drugstore, an average Raia customer spends 70 reais, leaving to the store 11 in pre-tax profit per checkout. Pague Menos in the PSP not only have smaller average tickets, but also lower store margins.
Overall, Haya has a higher EBITDA per store and superior top to bottom line growth conversion, as evident through its OPEX leverage. In order to analyze store profitability and if organic growth pays off, we simulated the opening of a single new store. In our unit economics exercise, even under conservative assumptions for same-store sales, we arrived at both IRR and ROIC comfortably above cost of capital. We see that expanding is indeed the way to go.
Okay, it's proven that Haya can grow organically now. But what else makes the company leave competition behind?
Well, the competitive landscape is challenging and a new threat has emerged. Small and medium independent players started getting associations, seeking to improve store execution and bargaining power with suppliers. They offered lower generic prices. As a result, Haya lost share in the segment. It was forced to strike back to aggressive discounts to recover participation.
But is this strategy sustainable?
We ran a generics price war simulation to evaluate the effects of more aggressive pricing policies. We analyzed gross margin impacts from stronger generics discounts for Haya, associated chains, and independent players, taking into consideration generics' different penetration in their product mixes.
The result was clear. Haya Drogasil's margins are less harmed by stronger generic discounts, allowing the company to withstand longer and win this battle.
And what about the returns?
ROIC does not set Haya apart from competition, though. We see that all players have tight NOPAT margins due to a low consumer advantage, with D&A expenses particularly weighing Haya down. Although invested capital turnover seems to be in line, all of Haya's possible edge is taken away by its low fixed asset turnover. We see the highest conversion of capex per store open into new revenue is actually lower than those of its competitors for the new stores.
But wait a minute. Until now, we presented a company that's well positioned in a sector with great perspectives. What then justifies the hold recommendation?
Overall, we do not see in the near future any major price catalyst able to justify incurring risk of buying the stock, which we believe is already close to its fair value.
So let's now take a closer look into our premises. We projected a recovery in mature same-store sales, reaching 5.1 in 2022. Store openings will keep going strong, slowing down only 2021 onwards. We expect more than 1.2 thousand new stores in the next years and projected under a 4-year maturation curve. As a result, net revenue will maintain a CAGR of 15%, which is in line with consensus estimates.
Gross margins should suffer short-term pressure from generic discounts, but the private label penetration and a slight growth of generics in the mix should boost it in the long term. Fixed expense represent most of SG&A for a single store, so the maturation of stores and a same-store sale growth above inflation should drive significant gains in EBITDA margin, which consensus sees as well. Expense were forecast linked by macro indicators, as well as the opening of new stores.
In balance sheet projections, we highlight gradual reduction in DIO levels, improving cash conversion cycle. Working capital is set to follow store expansion curves, growing initially with a 14.5% CAGR and then decelerating alongside expansion.
Capex will follow the same trend. Furthermore, store maturation will boost cash flow generation, allowing Haya to finance its own expansion as CFO surpasses CFI.
So you're telling me all these projections have already been reflected in the current price? Is that so?
Yes, in our DCF, we projected the FCFF for the next 10 years. We used a 0.72 beta to arrive at a 10.8% WACC. In perpetuity, our assumption were a 6% growth rate and no tax benefits.
Even under bullish assumptions, our upside was only modest. Our DCF arrived at a target price of 109.8 reais and 8.8% upside. Our recommendation was consistent through a WACC and perpetuity growth sensitivity analysis.
On a multiple analysis, Haya seems rather expensive. PE is at historical maximum, trading over 2 standard deviations above average. Not even aggressive growth premises justifies the stock price premium, as can be seen through the PEG ratio.
But what if our projections are wrong?
Our bull and bear case scenarios target price range from a 19% downside to a 30% upside.
1 minute remaining.
We ran 10,000 different scenarios in our Monte Carlo simulation, arriving again at hold recommendations 62% of the times.
The greatest risk to our model comes from major same-store sales fluctuation. In fact, in our tornado analysis, we find out that, indeed, same-store sales is the most volatile premise to our model.
We thank you all very much for your attention, and now we're open to questions.
Thank you.
Thank you.
Can you talk about the balance sheet a little bit? I don't think you covered that hardly at all. And how are they able to finance all these stores and the growth? Are they buying their own locations? Are they leasing?
Yes, sure. About the balance sheet, one thing that is important to highlight here is that we said in the pharmacy business in Brazil it's highly competitive. Stores are very close to each other. So one key element to be competitive in this business is maintain inventory of both high turnover products and low turnover products. So for instance, inventory is like 40% of the balance sheet. We have PP&E about 30% of total assets. So the company opens a lot of stores. The stores are not owned; they are mostly rented. But the store renovation capex demands high capital. So about 30% of total assets are in PP&E.
So just to a key takeaway here, I think, is to understand that this working capital dynamics in pharmacies in Brazil. So we can see here the four main players in this business, more than 40% of their assets are inventory. So why is that? Because you have a major problem that is stock out. That is the stock out. You have to have in your inventory a lot of products with low turnover, but they are essential, because if a customer goes to your pharmacy and they don't find in your pharmacy these products, they end up not buying anything and go buy in the next store. That's why we think that inventory is so important and is almost 50% of the total assets of pharmacies companies.
And just to finish the question about how the company finances its own expansion, it finances its expansion mostly by its own capital. As we said, the company has a strong cash flow generation, and it never had to raise leverage to expand. So the net debt EBITDA is always very close to 1, and the company only takes debt to some pointual needs of working capital, but its expansion is financed mostly with its own cash flow generation.
Can you comment on the opportunities for acquisition? The fact is that industry in Brazil has, it's quite fragmented, it appears. Perhaps not as much within Sao Paulo, but across the rest of the country. The major acquisition that they made was one from CVS, which got them into more e-commerce. But can you maybe outline, are there opportunities where they could take advantage of their high valuation and perhaps look at acquisition opportunities elsewhere within Brazil?
Yes, it's important to notice that not only about an offer, the company itself was formed from a merger of vehicles. As an opportunity right now, we see mostly in the south region of Brazil. As you once said, in the southeast region, it's very concentrated. In the northeast, the company is approaching a more organic expansion. But in the south, the company faces competition from three very strong players in the region. And we see Panvel as it would be a very good acquisition for the company. As we see some synergies, Panvel has besides being a lower scale of Hydro Brasil, it has a very good operation. It has good margins. So we did a simulation of Hydro Brasil acquiring Onofre, and we see that the deal will be mostly accretive for the company. We see that the two operations will really combine. Panvel is a very much smaller player, but it would be a very good way for Hydro Brasil to enter more strongly in the south region of Brazil.
And not just for the south region, but we also see Panvel as a reference player in e-commerce. It has, for example, lockouts like like Amazon has in the US, and it has its own private label, which is very strong. It's one of the strongest in Brazil. It would also be a way to boost highest product mix.
Okay, thank you.
Team, convince me that a 6% growth rate into perpetuity is not too aggressive, using whatever quantitative evidence you think supports that.
Yeah. So, do you want to talk? Go ahead. So, basically, we are talking about Brazil, that you have a high inflation. So we use as a G the combination of CPI, the inflation here in Brazil, that is around 3.6%, the projections, and as a growth rate as GDP, 2.4%. And 6% is indeed a high growth rate to use, but it's important to notice that we are talking about an industry with great growth perspective. As we said in the presentation before, Brazilian demographics is changing. So, for example, until 2030, there will be 15 more elders in the market. What does that mean? That the elders base in the market will grow by 50%, and there is 15 more customers willing to consume medicine twice as often and spend 4.3 times more. So we think that as it is a business in a great sector with growth perspective, we think that it's fair to assume this type of growth rate.
And about why this growth rate couldn't be bigger, we think 6% is fair enough because we're talking about Brazil. It's a more volatile economy. We've been for a few recessions. So a growth rate above 6%, even we're talking about the growth company, a growth sector, I think it will be extremely aggressive.
Yeah.
You demonstrated unit economics and particularly maturity of stores. Is this part of your projection as you were looking at the unit economics and sort of the recent buildup of the number of stores?
So the unit economics itself didn't go into our projections. We did it as an exercise. Our projection used the store maturation curve, of course, but the unit economics used mostly to analyze the profitability of a store and also to adjust our perpetuity. So we made sure we left no store to mature in perpetuity. So in perpetuity, we subtracted the cash flows of a store that were maturing. And when we assumed these stores were already matured in our perpetuity. So this is the main reason why we used our unit economics, the store cash flow.
Yeah, so, and one major problem about other big companies, like as we presented in our presentation, like Pague Menos and Extra Pharma, was that they had an aggressive store opening policy, but they couldn't afford it. So they faced margins deterioration and cash flow deterioration as well. And we would like to prove and understand that higher opening a new store and continue to open in this aggressive pace, it is indeed profitable, or we will harm companies' return. And this is our way to show that it is indeed possible and it will be able to continue its fast pace.
How did you guys run your price war simulation?
The price war, you can go there. Okay, so basically we had the penetration in these three in the company's mixes. So we had Raia Drogasil with 60% of branded drugs in their product mixes, and we did the same thing for independent players and associated chains, as we said. But we had to use some assumptions. So we used the market average. So we know that the average, average gross margins for non-reference, that is generics, for example, it's 55% here in Brazil. And for reference, that are these branded medicines, is 20%. And we also know that the average discount for these non-reference medicines is about 60%. So based on these assumptions and the penetration on their mixes, we could see that, okay, if Raia Drogasil increases their discounts for generics in 5%, how will be the impact in the gross margins? And if you can pass the slide, Aquino, please. And for the same thing for associated chains here, that you can see that branded medicines, branded drugs, is about 32% of their mixes, and generics and similar 68%. So using the same premises, we could be able to simulate that, and even to predict how much Raia Drogasil would be affected, in its own gross margin.
That's pretty slick. Thanks.
Thank you.
Thank you.
Did you do any work on the new growth of stores for the whole industry? And there's enough people in those surrounding areas where they're looking to expand to
That's time.
pay the prices? Okay. Thank you.
Thank you.
Thank you so much.